How do you make a stock selection process such that it can become the basis of a hedge fund? Here's how, and let's go through it. So the first thing I wanted to do was not only pick stocks which are value stocks or income stocks or growth stocks, like you get the Fidelity Growth Fund or the Value Fund or the Japanese Income Fund. I wanted things which ticked all three boxes because you never know when the market's going to pick one over the other. So I knew that required me, therefore, to select what criteria to look at in each of those. So what criteria for valuation, for income, for growth, and to weigh what would be important and what wouldn't. For that, I looked at the academic literature and the data and the analysis from academia and from investment banks on what works in stock selection. That then led to the next stage, which was to look at some of those quantitative numbers. And what happens when you looked at the numbers themselves? Well, you came up with some pretty good stuff. You came up with variables such as price earnings growth was important, price earnings ratios were important, and you weighed those things. Revenue growth was important, cash flow growth was important, and so were dividend yields. What you then do is you say, well, okay, if those are the factors which are indeed important, then now I've got the beginnings of ticking each of those boxes or circles to get in the middle there. I will take in the stocks. You need a lot of data statistically to get to something which might be relevant. So we put in every single stock that we could get our hands on listed in the UK, US, or international stocks listed in the US. That gave us about 10,000 stocks. You want to add a risk management rule, I'll come to that in a second, and a money management rule. And that gave us a core portfolio of 14 stocks. What were the various rules? Well, first things first, we wanted transaction costs to be low. Now, since we were holding things for 12 months, that necessarily meant transaction costs would be low and they wouldn't be churning. For money and risk management, we made sure 25% per position hard stop loss means no position can impact the portfolio more than 1.8%. Because if you divide your whole portfolio into 14 equal positions, then 1/25th of 14 is about 1.8 positions, 1.8%. Now imagine you take a random 200 million equity fund. Actually, the risk impact of the top 10 to 12 positions that fund, somebody's fund might have, would be also 1.8% on their fund. So you actually were keeping risk management to institutional grade levels. Anyway, that's it in outline. Follow and I'll go into more detail in future.